Hello, and welcome to another episode of IJS Speaks. This is your neighborhood financial economist, Katie Mark, and today is Saturday, June 5th, 2021. It is 1:41 p.m. Eastern Standard Time. So today I want to talk about derivatives, more specifically hedging with futures and option spreads. A lot of traders are familiar with equities because they're more talked about. There's a lot more information on the internet, on TV, in books about stocks and stock trading. It's been around for a long time. Something a little bit more esoteric that's not necessarily covered are derivatives. Typically, derivatives require a little bit more capital because they're usually traded on margin. But because they're traded on margin, you also get the benefit of leverage. Now, leverage is a double-edged sword because when it's working in your favor, it's a beautiful thing. It multiplies your earning potential. But when it's working against you, it's a very bad thing because it multiplies your losing potential, which is why understanding risk and understanding specifically the amount of risk that you're taking is very important, and also having a very clearly defined risk management strategy is very important when dealing with derivatives. Another aspect of derivatives that makes it a little bit more complicated and nuanced is the time factor. When trading equities, for instance, in theory, you can hold on to stocks, ETFs, mutual funds indefinitely. With derivatives, so with futures, with options, they all come with an expiration date. So you're no longer just thinking in terms of can the price go up, down, or sideways. You also add the dimension of time as well. Because you can be right, but you don't have forever to wait to be proven right. At some point, your derivative contracts expire, and depending on how you're set up with your broker, they either roll over, like with futures, or with options, they expire worthless. So there's a little bit more to take into consideration when trading derivatives. But if you can wrap your mind around the additional dimensions of complexity, it's worth the effort. I'll start with futures. I'm not going to go into defining what a futures contract is. There are many more detailed explanations on the internet. You can run a simple internet search. Same thing with options. I'm not going to define what an option is. I'm going to assume that if you're listening to this, you have an understanding of what these contracts are. And if not, you have the ability to find out what these contracts are and how they work. I use futures contracts to get exposure in the currency markets compared to trading spot forex, for instance. Now keep in mind, I traded spot forex for years, and that was all I traded for a long time. So I basically learned technical analysis trading the spot forex market. Very volatile, also leveraged, and when I was wrong, I lost money. When I was right, I made money. As I got a little bit better with the technical analysis, I found other markets to get different types of exposure that I can manage a little bit better. And I was able to use futures contracts to get those exposure. So with the currencies, I still track the dollar index. and take my guidance for the currency markets from the dollar index because I only trade the majors. So the currency futures that I typically look at are the euro, the Aussie, and the pound. There are futures on most of the majors: Japanese yen, Swiss franc, New Zealand dollar, Canadian dollar, etc., etc., even some of the minors. I tend to focus on just a few of them because, again, I'm not exclusively trading currencies and I do not have unlimited capital to invest and to trade. So I do need to spread my margin around across different markets. I also trade futures on stock indexes and on bonds, more specifically the 10-year treasury. And from time to time, I'll also take exposure in the grains market: corn, wheat, soybeans. I'll trade those futures contracts as well, in addition to other commodities like gold and oil, which periodically, if I see a setup on my charts and I do my analysis, I think the risk to reward is worth it, I may also take on futures exposure in the oil market or in gold. One of the biggest benefits of trading futures to me is the 24-hour liquidity. So unlike trading equities, stocks, mutual funds, ETFs, which typically trade during a set time frame, so whether it's the New York session, the European session, Asian session, or in the case of a select few, they do trade 24 hours because they're just that liquid. But the majority of equities typically trade during a specific session. Outside of those sessions, there is some after hours trading, but it's not as liquid, and you may not be able to get all of the exposure that you're interested in. With futures contracts, once they start moving, typically on Sunday evening, as the Asian session comes online, they keep trading with some intermittent breaks in between, again, depending on the market, but for the most part, they trade continuously for the entire week. That's important for someone like me because I follow the financial markets across the world, and different time frames or different market sessions generate different moves in different markets, and I like to be able to take advantage of market movements in different time frames and during different trading sessions. Typically, with the stock index futures, I look at the S&P 500. With the bond futures, I look specifically at the US 10-year treasury. Like I mentioned before, futures contracts trade on margin. They're also very leveraged. So basically, you put a small amount of money down relative to the amount of exposure that you're taking on in your portfolio. Hedging also works very well with futures contracts because of that time factor. And the way I typically utilize hedging in futures is with the currency futures. They're not like the spot forex market. Currency futures are still fairly volatile. And even when the market is churning, there's opportunity to make money because even during a churning market, the moves are outsized. So with the currencies, what I typically would do is I would pick a direction based on my technical analysis, whether it's a chart pattern, a candle pattern on a longer term chart, or a setup based on my technical indicators. So I would use my technical analysis to figure out a direction. I would also use my technical analysis to position myself, so to enter the trade, find the right point to enter the trade, set up my exit targets on the trade, whether profitably or to minimize my loss, and then I enter the trade. When the trade is moving in my direction, That's fine. It's beautiful. I'm making money. If on my shorter term charts or my intraday chart, I see some kind of a reversal pattern, which is typically candle pattern setup or maybe even a chart pattern forming, I look to hedge those currency futures. So I don't necessarily want to close out my underlying position simply because the charts are telling me that we're in a consolidation pattern or maybe there's a reversal pending. Because typically you see consolidations, you see pullbacks, and then the market continues on with its initial trend. So in order to maintain my underlying position while not risking the margin in my account, I would typically hedge my futures positions, especially in the currency markets. So I establish an underlying position in the front month, so in the current month's contract. Then to hedge, I go out one expiration cycle, whether it be the next month or a couple months out, whichever is the next contract set to expire, ahead of the current front month contracts that I own, and I will take an opposite position. So for instance, if I'm long in my underlying position, I would go out one expiration period and go short and basically set up a calendar spread. Now, as the underlying asset moves, so let's use the euro, the Aussie, the pound, for instance. If I'm long the euro, Aussie, or pound, which corresponds to a short dollar play, and I see some kind of a reversal, some kind of consolidation, I would go short out one expiration, creating a calendar spread. So I'm long the front month, short a future month, and that basically cancels out the two contracts. So I'm holding the underlying position, but one goes up in value, the other one goes down in value, and vice versa. And that leaves a net effect of 0 on my portfolio and my margin. So while the market's consolidating, bouncing sideways, or especially when it's reversing, I would have a net effect of 0 on my balance. Once my analysis, my charting tells me that the consolidation is poised to break out, the reversal has played out, and the price looks to be getting back onto trend, what I would typically see is my underlying position would have lost value, but my hedging position would have made up the same or similar amount of value that my underlying position lost. I take profits on my hedging positions and wait for my underlying positions to regain what they lost as they get back on trend. The net effect of that is by the time my underlying position gets back to where it was initially when I hedged, the balance in my account would have increased because I captured the profit from my hedging position, and then my underlying position regained all of the value that it lost while it was hedged. And the net effect of that is I've got more money in my account to play with. I use this most often for the currency futures because, again, they're more volatile, and especially with the dollar index in a consolidation pattern on the longer term charts, I've been getting a lot of sideways movement, and sideways movement in the dollar means it's up one day by a considerable amount, it's down the next by a similar amount. So overall, I'm looking at a long-term move higher in the dollar, which I'll cover in more detail in the forecast part of the podcast. So I am short the Aussie, the pound, and the euro. And that consolidation pattern on the longer term charts plays out as sideways movement on my shorter term intraday and intra-week charts. And it basically has been creating a range. So whenever I see the dollar index at the top of the range, I look for reversal patterns in the charts and with my technical indicators. Candlesticks hint towards that too, but chart patterns and the technical indicators tend to go together, and the candlesticks can then confirm. I would initiate a hedge. As the dollar index moves towards the bottom of the range, I would once again start looking for my technical indicators, my chart patterns, and candlestick patterns for confirmation that the downward leg is ending. Take profits on the hedge and wait for my underlying position to regain what it lost while it was hedged. So basically, the overall movement in the dollar index and in the currency futures have been sideways, but by trading the range, hedging and unhedging, I've been able to generate profits in a sideways market. In the spot forex market, that would be difficult. I would have to find either a synthetic hedge by combining two cross rates, or finding a correlation hedge by looking at something that has a strong correlation to my underlying to find or to provide some kind of an offset. So this would be a lot more difficult in the spot forex market, which is why I started looking at other markets for other types of opportunities to capitalize on the same charts and the same information that I was analyzing in the spot forex market. I don't hold a significant equities portfolio. I do have an equity position in BLOK, which is an ETF that tracks blockchain. And of course, with the recent trading action of Bitcoin and other cryptocurrencies, the ETF is down from where I got into it. But to remove that time aspect from the analysis, I chose to go with an outright equity position versus a derivative of an equity position, because I do believe that blockchain technology is here to stay. Like I mentioned in previous podcasts, I'm not sure if the cryptocurrency format is going to be the format that survives, but the technology can be used or can be utilized for legitimate purposes. So I do think that it is here to stay. Hence the ETF tracking blockchain, which again, it's influenced by Bitcoin because it is a big part of what blockchain is currently used for, but not the only thing that blockchain is used for. So I don't necessarily use stock index futures to hedge a stock portfolio, but if I did have a stock portfolio, I would be interested in knowing what the beta of that portfolio is, which is basically how correlated is my portfolio to the S&P 500. And if I had a high beta portfolio, or a portfolio that was strongly correlated to the S&P 500, whether positive or negative, I would then be able to use futures contracts on the S&P 500 or the Dow or the NASDAQ or whichever other stock index that you can find futures contracts on to offset the downturns in my portfolio when the market sells off. So I use the futures contracts on the S&P to speculate. My technical analysis, look at my charts, look for chart patterns for breakouts, look at candle patterns. I look at my technical indicators to confirm my other two forms of analysis. And I take speculative positioning in the S&P 500 as a proxy for the US stock market through futures contracts. Similarly with the 10-year treasury, it is the most liquid government debt market, the market for 10-year treasuries. Granted, prices are grossly distorted by the amount of activity that the Federal Reserve has taking in the 10-year treasury market for the past decade plus. It is still by far the most liquid government debt market, and it is a very good proxy for sovereign debt. Through the bond futures contracts, I tend to speculate in yields and corresponding bond prices versus buying outright bonds and taking a one-way bet, which is up in price, or holding for duration and yield, which I think it's not worth locking in these low interest rates now for 10 years in the face of rising inflation and an increasing chance of rising interest rates. Then there's the grains. Because of the volatility in those markets, I can use a similar approach as I do with the currencies to hedge the futures contracts. So I'll take a underlying position, and if I need to, based on my charts, I can hedge with a calendar spread. Have a net effect of 0 as my underlying positions move against me and the hedge positions make up the loss. Take profits on the hedge positions, again based on the technical analysis, and play the underlying position over a longer period. Another form of derivatives that I do like to play with from time to time are options and option spreads. I'm not going to go into definitions of what are options or even what the spreads are, how they're structured. If you're interested, there's a myriad of resources that you can find on the internet. You can find in library books, you can find by talking to more experienced traders, you can find in forums, or even contacting me directly through my websites, where you can learn about what the spreads are, how they're structured, and how they work. What I like using option spreads for is managing my downside. Now, with an outright futures contract, I need to be monitoring my position and looking at my charts to try to identify when there's going to be a reversal, consolidation, and initiate my hedge based on what I see on my charts. If I'm off doing something else while the market moves, at risk for unlimited losses, really, if those positions move against me. With the option spreads, it's a little bit different. If you're just doing outright options contracts, you can find yourself in a position where your risk is unlimited. I personally like using the spreads because it's a great way to cap your risk. So you know what your max loss is going into the trade. The downside is that those options are only priced during the trading sessions when those equities are traded. So in my case, my brokerage account is a US brokerage account, so they only reprice during the New York trading session. So the underlying equity can move throughout the night. My options won't reprice until 9:30 a.m. Eastern Standard Time, Monday through Friday. But on the upside, I get to know what my risk is going in. And if the market is trending, or if I'm looking at a trade that will play out over multiple days versus something that may or may not play out overnight, intraday, intra-session, then I can opt to go with an option spread versus an outright futures exposure. And typically, the leverage is different on options on futures or even futures contracts themselves than on options of equities. So, if I want the exposure, but I don't want to commit as much capital, options on equities are fine. If I want the exposure, I have the capital to commit, and I think it's going to be a short-term play, the futures contracts work better. Or as a hybrid, if I want the 24-hour tradability, but I also want to manage my potential downside, options and futures contracts are a great way to go. So sometimes I trade outright futures positions. Sometimes I trade options on those futures positions. It just depends on how I structure my risk and how I structure the portfolio based on my expectations for the time frame in the trade. This week I traded across the board, traded currency futures, which were outright futures positions. I traded option spreads on the SPY. I also traded option spreads on the S&P futures contract, as well as option spreads on the 10-year treasury and option spreads on grains. Now, I went with the options spreads on the grains because the expiration on those futures contracts were several weeks out. A lot can happen in those markets. Those markets are very volatile. So I wanted to manage my exposure in the interim. If it was closer to expiration, I would probably go with the futures on the options contracts, because you have the ability to roll over your futures contracts if you need more time, versus with the options, they just expire. Because the dollar's in a consolidation pattern on a longer term chart, I chose to go with outright futures positions because I'm continuously tracking the dollar, and I use my candle patterns, chart patterns, and technical indicators to highlight reversals. Plus, the dollar has been setting up a very clearly defined range on my shorter term charts, so it's easy to identify the highs and the lows and when to hedge and take profits on my hedges. The 10-year treasury was surprisingly volatile towards the end of the week, which was a losing trade for me, in all honesty. The approach I took at the beginning of the week, I was looking at a call vertical initially. I saw the price trading below a support level, took a loss on the call vertical, opened a put vertical. The put vertical was below the market. The market never got down to the range in the put vertical. Got closer to the end of the week, took a loss on the put vertical, salvaged what I could of the premiums versus letting it all go at expiration. And I was looking at a market that was trading with very low volatility, so I took a position with an iron condor. Depending on what you think about volatility, whether it's going to be increasing or decreasing, determines whether you buy or sell the spread. When you buy an iron condor, you're expecting volatility to push the price either up or down, and you capitalize with call verticals above, put verticals below. If you think volatility is falling and the price is going to consolidate sideways, you sell call verticals above, sell put verticals below, generate a net inflow of premiums, and the idea is the price stays between those two verticals and you get to keep the premiums at expiration. If anyone was watching the markets on Friday, they saw that mid-morning towards the London close, saw a big spike up in 10-year treasury, spike down in the dollar, spike up in the S&P, and that pushed my 10-year treasury option spread into the negative. So I had to close that one out again. Took a third loss on the 10-year treasuries. Salvaged what I could versus waiting till expiration and risking a lot more in premium. Now I have to take a closer look at my charting. Look for a clearer picture of a range, and if I can find a clearly defined range in the 10-year treasury price, then I can set up call verticals or put verticals inside the range, and or sell my condor spread outside of the range so that the price stays within the range, the condor spread benefits, and if it goes outside of the range, I can salvage whatever I can on the premiums on the condor, but the vertical spread should be able to pick up the difference, and the idea is to net out between the opposing spreads some kind of profit. Grains, I had call verticals on my grains. Again, when there's increased volatility, the broker tends to adjust the margin requirements. So I had to, again, raise cash to cover increased margin. And I took profits prematurely, albeit, but I took profits on my grain spreads, which was fine. Futures contracts on the currencies, those are also profitable. That sideways movement, I took profits on both the underlying and on my hedged positions. This has been the second week of trading that sideways movement in the dollar. Again, I'll look to reestablish as next week's trading session comes back online. And with the stock index futures, I had a similar iron condor spread that I sold on the S&P futures contracts, which was profitable. It closed within the spread, so I got to keep the premiums from the verticals, as well as a similar approach on the SPY ETF. Sold an iron condor spread on that one too. Now, the reason I did one on the futures and one on the ETF was I wanted a little bit more exposure to that trade, but I didn't want to commit all the margin that it would have required if I wanted to add in more futures positions. So I went for a lower margin, lower profit potential on the SPY just to add to the potential profit that I saw in the options on the futures index. So looking at the dashboard, I'm still looking at the relationship with gold, the 10-year treasury, and at this point I'm looking to rearrange a little bit to put the S&P 500 next to them. So what it looks like is the relationship with gold and the 10-year treasury seems to be intact, but the 10-year treasury seems to have an even closer relationship with stocks. I was looking at a correlation measurement between the two, the S&P 500 and 10-year treasury. And on Friday, the correlation was up to, I think, positive 0.989, which if you round up is 0.99, which is almost 1-to-1. And I know in previous podcasts I talked about cross-asset correlations and the importance of looking at those correlations because they do inform on trading in other assets based on correlation relationships. It is worth keeping in mind, especially when correlations are so strong. Looking at the dashboard, the price on the dollar index is below its linear regression curve ribbon, which signals to me that the price is accelerating lower. It also crossed its pivot indicator. So the pivot indicator went from support and is now signaling resistance. all in response to that move that we saw mid-morning on Friday. The linear regression slope measuring momentum was positive going into Friday morning and sloping upwards, made a sharp reversal and is almost to the zero line. If the trend continues in the price, it will go negative. The linear regression slope measuring trend, also sloping upwards into Friday, started turning less positive. Compared to what I've seen in the dollar over the past couple weeks, it just looks like it's moving lower towards the lower bound of the range that it's been establishing. I don't have an underlying position in the dollar coming out of last week's trading session, so I'll wait until it finds its lower bound and then enter on my underlying long position, which would be going short the Aussie, the Euro, and the Pound. So until then, the expectation is for the dollar to travel a little bit lower. At close on Friday, we were looking at 90.134. I can see it trading down to about 89.75, maybe as low as 89.6 before finding a floor. So I'll keep an eye on the dollar, but going into the start of next week's trading, my expectation is for the dollar to trend a little bit lower and reestablish the floor that it set up over the past couple trading weeks. Crude oil is sitting in its regression curve ribbon. The regression curve ribbon is tilted slightly upwards. Doesn't tell me much. Within the Friday session, the pivot indicator on crude oil went from support to resistance and back to support. So from that standpoint, looking at the pivot indicator and the regression curve ribbon, crude oil just seems to be oscillating sideways with a slight upward bias. The linear regression slope measuring trend has been diverging actually from the price action. So the linear regression slope measuring trend has been making lower lows and lower highs starting mid-session on Tuesday, while the price has been slowly grinding higher. That divergence tells me that at some point, one of those two things are going to give. Either the price gives up its slight upward bias and takes a leg down to get in line with the momentum indicator, or the momentum indicator spikes upwards to get back in line with the trend on the price. The linear regression slope measuring trend, it's positive, but as of midday on Thursday has been getting less positive. So with the trend indicator getting less positive and the momentum indicator trending lower, so making lower lows and lower highs, it seems like the thing that might break first is the price. So from a technical standpoint, crude oil could be setting up for a leg down. I will continue to watch crude oil. I won't take on any exposure because of that divergence that I'm seeing. I'll also look at a cross-asset correlation play with the grains market. I'll look for confirmation to see if there are any bearish signs in the grains market to confirm the potential for a downward move in crude oil. And then I'll make my trading decisions from there as the session matures and I get more information from the charts. Since early in the Tuesday session, the pivot indicator on gold has been above it, signaling resistance. The price also started making lower lows and it seems like lower highs. So that indicates a downward trend. It is currently above its linear regression curve ribbon. So the price is accelerating higher, but that is in line with that move lower that we saw on Friday with the dollar. So That negative correlation between gold and the dollar may be responsible for that move higher in gold. If the dollar continues lower, we may see gold tick up a little bit, or we may see a bit of a break in that relationship if the pivot indicator on gold holds. The linear regression slope measuring momentum is oscillating around the zero line all the way up until Thursday, where gold took a considerable move lower. It consolidated late Thursday into Friday, and then the mid-Friday session it took a leg higher. So back to about where it sat, or where it started its downward move on early Thursday. So overall, between Thursday and Friday, gold is flat with a little bit of volatility in between. The linear regression slope measuring momentum is positive, however, which again corresponds with the move on Friday, but the regression slope measuring trend is negative. Now it did start plateauing on Friday, so you can see the influence of the move higher in the price, but for now it is negative on the trend. So I'll keep an eye on gold in relation to the dollar and see if I can get confirmation for my gold trade from what I can gather from the dollar index, and vice versa. So again, no exposure coming out of the week. I will be waiting to see how the market restarts before I commit to a direction one way or another. Looking at the S&P, Friday took that leg higher. It broke through its pivot point, so its pivot indicator went from resistance to support. The regression curve ribbon was trading sideways with a slight downward bias for most of the week. As of Friday, the price was trading well above the regression curve ribbon, which indicates to me that the price is accelerating higher. The regression slope measuring momentum, it's positive, getting more positive. The regression slope measuring trend is negative, but getting less negative. And again, all corresponding with that move on Friday. So, price is accelerating higher. It has support from its pivot indicator. Its momentum is increasing and its trend is turning positive. Also, from a chart pattern standpoint, the S&P is flirting with an all-time high. So if we get a break above that, that could inspire an influx of capital into equities, and we can get a significant leg higher before we get a consolidation or some kind of a reversal back to where it is right now, which would effectively establish a switch from resistance to support. So I'm watching how the S&P opens up. If we close above that old high, so establish a new high, and then get a little bit of momentum behind it, so the trend turned positive, momentum keeps accelerating, price keeps accelerating, pivot indicator signaling support, then I would be inclined to go long the S&P 500 index. That I may choose to do with an option spread on the SPY, so that if necessary, I can always lean into the trade, add more positions. But I may also choose to offset or to hedge that SPY play with an option spread on the futures contract with a shorter time frame, so with a closer expiration. That way I can capture some intra-week moves with an eye on an end of week expiration on the SPY options. Then there's the 10-year treasury, which on Friday price accelerated higher, so it's currently above its regression curve ribbon indicating an acceleration in price higher. The ribbon, however, has been trading sideways all week, and the price has been oscillating around that all week. From early Thursday, we see that down move similar to what we saw in gold. Consolidated mid-Thursday into early Friday, then you saw that up move. The 10-year Treasury, however, has surpassed the level it was on Thursday when it started that leg down. All week, the pivot indicator has been oscillating from support to resistance and back. So there's no clear picture with the pivot indicator, but it is accelerating higher. The linear regression slope measuring momentum was flat, so oscillating around the zero line for most of the week. Took a dip on Thursday, corresponding with the leg down. Bottomed out and accelerated higher, back positive on Friday, and it looks like it's poised to get more positive. The linear regression slope measuring trend has been oscillating around the zero line all week, and because it's a little bit slower to respond to the price, it barely peaked above the zero line on Friday. So we'll see if that continues to oscillate. If it continues to stay close to the zero line, then we can expect a relatively sharp reversal in the 10-year Treasury price lower. But with the high correlation with stocks, if we see a sharp reversal lower in 10-year Treasury, we may also see a sharp reversal lower in the S&P 500 and also with gold, but not on quite an exaggerated level. So that's also worth looking at because of the correlations between those three asset classes. A big move in one typically manifests as a similar sized move in the others. That's the dashboard going into next week. There aren't very many clear pictures. The dollar looks poised for a continuation of its move lower. Crude oil similarly is poised for a breakdown in price because of a divergence between the price action and the linear regression slope measuring its momentum. Meanwhile, the 10-year Treasury looks like it's accelerating higher. So does stocks, which, based on the levels of correlation, hints that gold may also be poised to move higher. If crude oil prices break down, we may see a similar breakdown in the soft commodity prices as well. And a move higher in gold will correspond with a move lower in the dollar. So that's the dashboard going into next week's trading. It looks like on one hand, we can see an extension higher on gold, the S&P, and 10-year Treasury. And on the other hand, we may see a bit of a reversal in the dollar and crude oil and their corresponding correlated trades. So looking out at a longer term chart, the dollar again is well within its consolidation range. The chart does indicate that we could take it as low as 88.25 compared to where it closed on Friday at 90.13. That's a bit of a leg lower. So I'll be watching the dollar. If it gets to that level or close to that level and I see a reversal pattern setting up on a shorter term chart, then I will look to reestablish my long dollar positioning. If it breaks below that, that would be a signal to me to establish a short dollar trade. So as of now, I'll sit out the dollar trade, wait for more data from the charts, let a clearer picture develop, and I can take exposure then versus trying to, at this point, guesstimate where the market is going and run the risk of committing capital and wasting time watching a position move against me, which I will have to hedge, and have to pay commissions for those contracts, when I could just sit out, wait for a clearer picture to develop, and then enter my positioning from there. The longer term charts on crude all look positive. So it still looks like crude is heading to about $76, $77 a barrel. So there is a bit of a divergence between what we're seeing in the longer term charts and what we're seeing in the shorter term charts. If crude keeps marching higher, it's heading to about $76, $77 a barrel. If we get a downturn, we could see it drop to as low as, again, $60 a barrel, reestablishing that level as support. It's worth watching, not necessarily worth trying to time it and run a similar risk as with the dollar of entering a position, paying commissions, then either having to realize losses or just have to pay more commissions to hedge your position. You're wasting time, wasting money. I might as well just wait for a clear picture, wait for a clear confirmation, and then establish exposure from there. The gold chart looks interesting because it's sitting on top of support. So, another market also worth watching. If it breaks above, we're looking at a move higher, probably on its way back to $2,000 an ounce, and more than likely back to its all-time high, pushing $2,100 an ounce. But if the move higher can't be sustained, then you're looking at about $1,740 on the low side. So another market worth sitting back and watching based on my long-term charts. But with the shorter-term chart and the correlation that we're seeing with gold, the S&P, and the 10-year Treasury, it does look like it's poised to move higher. The S&P 500, at this point, I really think it's moving higher to about 4,300 on the index. From there, we can see consolidation, maybe another retest of the 4,050 level, or it breaks through that and moves on to 4,600 on the index. But at this point, it does look a lot closer to 4,300 than it does to 4,050. It looks like it has the momentum. So it would be interesting to see in the next couple of trading weeks if we can hit 4,300. Initially, I expect consolidation, but if it does break through it, like it did the 4,050 level, then it's going to be a clear push higher, maybe to about 44, 4,500 before we see some kind of consolidation and a pullback to establish that 4,300 as support after breaking through it as old resistance. Then there's 10-year Treasury. So the 10-year Treasury looks like it's moving lower. It has a lot of resistance. It's using its regression curve ribbon as resistance. It's also using the 23.6% retracement level on its Fibonacci as resistance, which is where it closed on Friday. So if that holds, then we're seeing a reversal in stocks, we're seeing a reversal in bonds, and we're also seeing a reversal in gold, which would correspond with a move higher in the dollar. And crude oil is still kind of doing its thing, not necessarily correlated with those other main asset classes. So, looking at the 10-year Treasury, I still, from a macro fundamental standpoint, believe that rates should be going higher. The Fed started talking about tapering corporate bond purchases or their corporate bond holdings. So they're taking incremental steps towards tightening monetary policy. We're getting more and more positive inflation data. The employment data, however, is not necessarily coming in as expected. So if the Fed is exclusively looking at employment data, we may have a chance of overshoot on inflation sooner than expected. But we get that overshoot on inflation, it's going to force their hand to move. Long story short, as an economist, I do think that we have more stimulative, accommodative policy behind us than we do in front of us. And that does not bode well for bonds. In the medium term, looking at corn, soybean, and wheat, their momentums are all turning positive, or in the case of corn, just turned positive. Their trends have plateaued, but they never really lost that strong positive uptrend. They just lost a little bit of momentum in the interim. The prices are also holding support on their regression curve ribbons in the medium term. So from an indicator standpoint, in the medium term, the grains look poised to continue their move higher. That does line up with what I'm seeing on the longer term chart with oil. So referring back to the dashboard, that divergence between the price action and the intra-week momentum, we may just see the price accelerate higher and the momentum indicator have to spike to catch up, looking at the feedback I'm getting from the grains market. So that's worth looking at as we get closer to expiration on the front month contracts. I will consider exposure in the grains market and look to take advantage of the picture that I'm seeing developing just looking at my technical indicators. Corn, I see a candle pattern that typically highlights a reversal. It is a hammer pattern for those of you that are familiar, which it established towards the end of May. And then from a chart pattern, it broke above an old resistance level, and it seems like it is now using it as support. Wheat, looking at a bottom that it established around the same time at the end of May, is now demonstrating a bull flag pattern. And soybeans, similar to corn, seems to be using an old resistance level as support. But looking at the candle patterns, as well as my technical indicators in grains and medium term, they all look poised to move higher. So that may be worth considering when looking at positioning in oil. And on that note, we'll wrap it up. I talked about technical analysis today. I talked about chart patterns, candle patterns, and technical indicators, all of which you can find more information on at rtn.education. That's rtn.education in your browser. Hit enter. It'll take you to my website where I offer courses on technical analysis. You can purchase pre-recorded courses, or you can book one-on-one sessions with me personally. You can also visit my website, runthenumbers.biz. That's RUNTHENUMBERS.biz. Hit enter in your browser. And you can look at my trading, coaching, and consulting services. This has been another episode of IJS Speaks. This is your neighborhood financial economist, Katie Mark. As always, when in doubt, take profits.